Today we're going to talk about the Amount B guidance the OECD has published under the Pillar 1 BEPS Action Plan 1. And this work from, I believe, February 2024 is going to be included in the update of the 2022 Transfer Pricing Guidelines. It'll be a part of Chapter 4, which deals with administrative approaches to avoiding and resolving transfer pricing disputes. And you can see there letter E is safe harbor, so I assume it will belong there, but it will be added as an annex to the chapter. So it will be Annex 3, and the report itself says the following sections of this report are added to the Transfer Pricing Guidelines as an annex to Chapter 4. And then if we look at the table of content, it gives you an executive summary. It talks about why they are doing this as part of Action 1, etc., and making things easier for taxpayers as well. Some of the considerations applied in the simplified and streamlined approach, such as, for instance, that they would not include intangibles or commodities, and that also then covers transactions in scope and what is not in scope. It only is for routine distribution and marketing, including activities of commissionaires and agents. It talks about what is the appropriate method, and fortunately they have taken T&M, so we're sitting with EBIT rather than gross profit or the resale price method, because it would leave too much uncertainties about the actual taxable income of the taxpayer if you still had to go through the whole of the Opex. And then what we primarily discuss in this video will be Chapter 5, dealing with the return under the simplified and streamlined approach. It seems like quite a complex process, but if you go through the steps one by one, they do make sense, at least most of them. It talks about the documentation that's required for proving that you actually qualify for this simplified and streamlined approach. Talks about entry date issues and transitional issues, and then also about tax certainty and elimination of double tax. And there will be some text added to the commentary of Article 25 on MAP procedures. The long and the short basically being that unless both countries sign up for the simplified and streamlined approach, this approach cannot be used during MAP, either by the governments or by the taxpayers. And then there's some very useful illustrative examples, which I am going through next together with you. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. So if we look at how we determine our prices, just at a high level, the steps that we go through, we first determine what our industry grouping is, because there are different ranges for different industry groups. And there are 3 industry groups. We'll look at them in a bit. Once we know what the industry group is, we also look at their assets and their OPEX in relation to their sales to make sure that our industry doesn't have way more or way less our tested party assets than our benchmark, or way more or way less OPEX than our benchmarks. And if we do, we need to make some adjustments for that. And once we know that, then we can determine our pricing range. So then we can see we need to make a return on sale of 2% or 4.5% or something like that. We do then need to make an OPEX cross-check and adjust if needed. And the theory here is, the benchmarks that we use to come to, let's say, the 3% return on sales has a certain OPEX within which that happens. If your OPEX is much lower, the tested parties, then you're clearly doing less than the benchmark, or if your OPEX is much higher, you're doing more. So it's a bit of a repeat of step 2, I think. And then finally, you can also make jurisdictional net risk adjustments where applicable. So countries are getting some credit ratings, and if a country has a bad credit rating, then you need to increase your margin, for instance, from 3% return on sales to a 5% return on sales. So let's look at the first example. And you can see here we've got a number of years. We've got the 3 years before the tax year, 2 years, and then the year before, and then the tax year itself. And we go a bit through the P&L. We've got the sales and the COGS and the gross profit and the OPEX and the EBIT. And then we calculate a return on sales, which then would be, in this particular case, you take the 4 in EBIT and divide by 199, obviously, to get your return on sales. And for your operating expense, you would take the OPEX of 50. You would divide the 4 in EBIT by that to get your next percentage. And then we also need to make a working capital test. So what we do here is we look at the fixed assets, the debtors, the stock, and the creditors. And now, obviously, if you want to calculate your working capital, you need to take your stock, because that's more or less cash all the time that you need that you have. You have your debtors that haven't paid you yet, so that is cash that you must have. And then you've got your creditors to whom you owe money, so that is cash that you can offset against the debtors and the stock. And then you come to your working capital, which in this particular case is the 25 plus 30 minus the 33 in creditors, so it gives you 22 for year minus 3 and 6 and 15 for the other years. So now we've got our working capital, and the working capital is money which is stuck in your business, right? You need that to do your day-to-day affairs, and then the interest cost of that working capital is a comparability factor, because if you, for instance, have $1 million stuck in working capital in a 5% environment, that will mean you've got 50,000 in costs per year, where a company which only has 10,000 in working capital requirements would have much lower interest costs on the money that they need to keep in their business. Now, if we go a little further and we look then at what this operating asset and expenses intensity is, you calculate your fixed assets, which we know from here. Then you take your working capital, which we know from here, and you add that to it. And then you get your net operating assets for the 3 different years. And you work with averages of the 3 years before, or if you've only been operating for 2 years, then 2 years, or 1 year, then 1 year. And now when you calculate your net operating asset intensity, you divide your net operating assets by your sales for the average numbers over the 3 years. And in this particular case, you can see you get an OAS of 29.2%, because your average operating assets were 175 and your average sales were 600. You do the same to calculate a operating expense intensity, except now you divide your average Opex over the past 3 years over your sales, and you see you get here 143 divided by 599, giving your OES of 23.87. And with this data, you can now see what your base rate is that you're supposed to be making before we make any further adjustments. So there's another table which gives you your base rate adjustments. You can see we've got the 3 different industry groups, and then you need to look at what your OAS is, your operating asset intensity. So ours is 29.2, so we don't fall in category A or B. We fall in category C, and now we need to determine what our industry grouping is, and then we know what our base rate is. So we are in industry group 1, so we need to have a return on sales of 2.5% in principle. So if we now look at our calculation further, you can see we had 3.5% return on sales. We're supposed to have 2.5%, so we need to reduce our EBIT by the 1%, right? Our return on sales. So if we look at the industry groupings just before we do that, then you can see the categorization of industries and industry sectors into 3 predefined groupings based on observed relationships between the specific industry/products and their profitability for baseline distribution of those products. So they put together industries which you don't think belong together, but apparently they fall within the same profitability groups, right? So the first group is perishable groups, perishable foods, groceries, household consumables, construction materials and supplies, plumbing supplies and metal. Then the second group is kind of the rest group. It is IT, hardware and components, electrical consumables, animal feeds, agriculture supply, alcohol, tobacco, pet foods, clothing, apparel, plastics, chemicals, lubricants, dyes, pharmaceuticals, cosmetics, health and well-being products, home appliances, consumer electronics, furniture, home and office supplies, printed matter, paper, packaging, jewelry, textiles, furs, new and domestic used vehicles, vehicle parts and supplies, mixed products and components not listed in 1 or 3. So it is a rest category. And then the third category is medical machinery, industrial machinery, including industrial and agricultural vehicles, industrial tools, industrial components, and miscellaneous supplies, right? So these are our categories, and we fall, for our example, under category 1. So we do foods and the like. And then what is excluded from amount B is the distribution of non-tangible goods, services, or the marketing, trading, or distribution of commodities. And I think the idea is that commodity prices are published already, so we don't need to have separate benchmarks, because in principle you should have cups for those, although the definition of commodities under amount B is quite wide. So if you look at how you now determine your profit range, for our example here, our initial example, if you look at our numbers at the top here as well, we had sales of 200, cost of goods sold for 144, and a gross profit of 56 Opex, and then an EBIT of 7, which gave us a return on sales of 3.5. But that is too high. We need to be at 2.5, so we need to come down 1%, right? And the only number we really can change is we can change the cost of goods sold, because we're selling internally. This is a related party distributor. You can't change the sales because those are hard numbers with external parties. You can't really change the operating expenses because those are hard numbers with third parties and employees, etc., as well. So the only one you can really change is the Opex, and if you need to go down by 1% on sales of 200, that means you need to go down by 2. So if you increase your COGS from 144 to 166, that would bring you your return on sales of 2.5%. And now we are within the base rate range that we should be, but we need to go further. And if we just follow the steps that we've just done, we determined the industry grouping, we looked at the asset and expense intensities, and we then calculated which base rate we should follow, and then we identified the pricing range and made the necessary adjustment. Now, there is also a cross-check of the Opex, right? Because if your Opex is much higher than that of the benchmarks, then you might be doing more than what the benchmark companies do. And if your Opex is much lower, then you might be doing a lot less. And these benchmarks have been prepared by the OECD. They describe in Annex A to this document what their approach has been. So now Annex 4 to Annex 3 to Chapter 4 has an Annex A describing the benchmark process. And this is how we do these adjustments, right? So if we look at the numbers that we've had so far, we got to the 3.75. I believe they've changed the numbers slightly here to get us corrected. So you can see here we've got a working capital in year 3 years ago of 18, then 17, then 18, and Opex of 66, 59, 63. Now, if we calculate our weighted average asset and Opex intensity, we come to 31.39% and 5.51. But we need to look at what we are required to do, and we need. You can see here we came to a return on Opex of 75%, which is more than what we should have done. We should have done 70%, as you can see. 60%, as you can see in our table here in the top left, because we are in the medium OAS, not the high OAS, right? So we need to make these calculations now, and the way to do that is we need to go down from 4% to 3.75%. So we need to go down at a 0.25% of 200. That's half. So again, we make an adjustment to the COGS, and we increase the COGS by 2. And then the EBIT goes down by 0.5, which is a 0.25%. And you can see our calculation here by going from 182 to 182.5, while gross profit goes to 17.5. Our Opex remains 10, but our EBIT now is 7.5, and that brings us to a 3.75% return on sales, which is exactly what we're supposed to achieve under amount B. But we can go further as well, and sorry, I'm just showing how I get to the 75%. And that is we take the numbers are also in the example, but we've got 3 years in which we had this Opex of 11, and we had 3 years of which we had the sales of 199, 195, 205, which is our average, and then we take the averages of both those numbers, and that is how we calculate the 75%, which tells us our adjustment needs to come down to 60%, which is a 15% adjustment, right? So the second part, our Opex adjustment, is going to happen as follows. We have our numbers here. We need to come down to a EBIT of 6. So again, we need to increase our COGS, and we need to calculate exactly how much we need to go up by. So our Opex must be 60%. Our Opex is 10%, so the EBIT must be 6, right? Our Opex is 10, so the EBIT in our numbers here must be 6. to be 60% of the OPEX, but our EBIT is 7.5, so the EBIT must be reduced by 1.5, which means that we need to increase the COGS from 182 to 184, and that is how we make our cross-check OPEX adjustment. The last part, second last part of our adjustments is that the OECD do for some countries also publish their sovereign credit rating by category, and that is if they don't have enough benchmarks for certain countries or data, they simply take the credit rating of the countries and then they offset the benchmarks for the data that they do have by these credit ratings. So if we have a country here and our country has a B- credit rating, which it means that we have a net risk adjustment of 4.9%. And what you do is you take your adjusted return on sales, and that equals your return on sales. So it's this 3.75% that we have calculated. Sorry, the 3% that we have calculated. You then multiply that with your net risk adjustment, which we saw is 4.9%, times your asset intensity, because I think the theory is you run your risk primarily on your assets, so you work with your asset intensity, and that comes to 3 times plus 4.9 times 31.39%, which we have calculated over here, and that is 3 plus 1.54%. So for this particular country with a -B rating, we need to compensate our distributor for the inherent country risk that it runs by providing it with a return on sales of 4.54%. Finally, we need to make an adjustment for creditors which are outstanding more than 90 days, because the benchmarks are made around 90-day credits when it comes to your working capital requirements, right? So let us assume here we've got the following scenario. We've got creditors for 65, 65, 55, and then we've got cost of goods sold, 181, 168, 177, and then you look at your ratio of creditors, but we'll get to that in a moment. The first thing to realize is when you know what your COGS are and what your creditors are, or when you know what your sales are and your debtors are, you can calculate how many times a year your debtors or your creditors refresh, compare to your COGS, right? And the idea here is that your creditors, because they are intercompany companies, because you are a distributor for them, should not have too long outstanding for their payables, but also not too long, right? So if you divide in this particular case the 181 in year X minus 3 over the 90 days outstanding, then you see that the creditors should on average be for 44.63 should be the amount, right? That is outstanding. The amount that we have is 65, which means that it takes longer to pay the creditors than it should, and that's 20.37 too much. So we need to revalue our creditors when we make our calculations, and the way we do it is we take our fixed assets as we have them, and you can see here we've got 48 for fixed assets, 31 for debtors, stock 36, and then creditors for 65. So if you take the 31 plus the 36, that's 67, and you deduct the creditors for 65, you basically have a working capital requirement of 2, and that is way too low compared to what we have there, right? Because our creditors really should be 44.63 and 41 and 43, and we should not have subsidies from our product providers. So if we recalculate our adjusted and unadjusted asset intensity, first of all, the working capital, as we just said, should not be 31 plus 36 minus 65. It should be 31 plus 36 is 67 minus 44.63, and that will give us 22.37, as you can see here, right? And once you know what your working capital adjustment is, you can then calculate your net operating assets, which will be your working capital adjustment plus your fixed assets, and that now should give you 70.37. And you do the same for the other years, and so you calculate your average that you need to calculate your asset intensities and your OPEX intensities, and you can see unadjusted that was 24.7%, and now it is 34.25%, and your OES is 5.7. So when you go and look at your table of what your target range are, you would need to look at your table to determine your target range with an adjusted OAS of 34.25, not 24.7, so you won't fall into that bracket, which goes up to 29.9%. You will be in the higher bracket. So what this means is, by bringing our creditors down from 65 days to 44 days, we effectively increase our working capital and our net operating assets, and we also move our operating asset intensity from the 2.5 range to the 30 to 44 range, according to our adjusted OAS that you see here. I hope you enjoyed this video. I hope it makes the functioning of amount B a little more insightful, and I look forward to speaking to you again soon for further international tax issues. Bye for now.